Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to start our ratio analysis of Wolff Junction with something called the DuPont analysis. The DuPont analysis is a common method for trying to identify a company's competitive advantages or disadvantages. The analysis will break down this ratio called return on equity, or ROE, which is a measure of how much return the company generates for its shareholders. It'll break it down into three components: profitability, the efficiency with which managers are running the company, and leverage, or how much debt the company's taken on. And by breaking ROE down into those three components, we can see where a company is doing better or not as good as its competition. Let's get started. The analysis framework that we will be using is called the DuPont Ratio Analysis Framework.
Is this named after Henry DuPont?
Well, the DuPont formula is named after the DuPont Chemical Company, where it was developed in the 19th century. And I guess the DuPont Chemical Company is named after that the guy you mentioned before, so indirectly it is named after that guy. But since you interrupted me, let me try to preempt a question that may come up as we go through these slides. So in these ratios, we're going to compare income statement numbers like net income to balance sheet numbers like assets. The problem we run into is net income happened over an entire year, whereas a balance sheet number like assets is at a point in time. So what you'll notice is we're going to take averages of the beginning and ending balances of all of the balance sheet accounts to approximate the level during the year. So you'll see an income statement number for the period divided by the average of the balance sheet number using the balance at the beginning and ending of the period. The framework starts with the ratio return on equity, or ROE. This is defined as net income divided by average shareholders' equity, and it tells us how much return the company generates for its shareholders. In other words, for every dollar of shareholder investment, how much return or net income do the management team generate? There's two drivers of ROE: return on assets, or ROA, and financial leverage. Return on assets is defined as net income divided by average total assets. It's answering the question, how effectively do the managers use their resources or their assets to generate profits? So it's a measure of operating performance. For each dollar of assets, how much net income does the company generate? The other component is financial leverage, which is average total assets over average shareholders' equity. And this tells us how much debt does the company use to try to increase its total assets. So for every dollar of shareholder investment, shareholders' equity, how many assets are they able to buy? You're able to buy more than a dollar of assets if you take on debt. We're really going to focus on the return on assets because we want to understand the operating performance of the company. And there's two drivers of ROA. There's return on sales, or ROS, and asset turnover. Return on sales is a measure of profitability. It's defined as net income over sales. It answers the question of how much profit does the company earn on each dollar of sales. Asset turnover is a measure of efficiency. It's sales divided by average total assets. It's answering the question, how much sales does the company generate using its available assets? So for every dollar of assets, how much sales can it generate? Now, if we bring back down leverage, we can see the DuPont innovation was to notice that ROE, or return on equity, is equal to net income over sales times sales over assets times assets over equity. In other words, ROE equals profitability times efficiency times leverage. This decomposition will let us take a look at whether a company's advantages or disadvantages in their ROE is driven by their profitability, their efficiency, or their leverage.
My sister is a long-short hedge fund guru, and she says you always have to use deliver net income.
Your sister is exactly right. If we use regular net income in return on assets and return on sales, it will be affected by a company's financing decisions. So we do have to calculate something called delevered net income, and then use that in place of net income in ROA and ROS. So let me show you how that works. So let's look at how leverage affects return on assets. Ideally, return on assets would measure operating performance independent of any of the company's financing decisions. The problem is that the numerator of ROA, net income, includes interest expense. which means that the more leverage a company took on, the higher its interest expense would be, and the lower its net income. So to remove all the financing effects from ROA, we have to de-lever net income. So now ROA is going to be de-levered net income divided by average assets, where de-levered net income is defined as net income plus after-tax interest expense. So after-tax interest expense is going to be interest expense times 1 minus the tax rate, which is T. Let me show you a quick example. We have two companies, one that has no debt, one that has some debt. They have identical pre-tax, pre-interest income of $300. The company with some debt has interest expense, whereas the no debt company doesn't, which means the some debt company has lower pre-tax income. We multiply the times the tax rate, and we see that the some debt company has lower net income than the no debt company. But then if we add back after-tax interest expense, which would be 50 times 1 minus the tax rate of 35%, voila, we get identical de-levered net income between the two companies. So de-levered net income is not affected by borrowing decisions. So our corrected DuPont ratio analysis framework, we're going to use de-levered net income in ROA, and we're going to use de-levered net income in return on sales.
This is so boring. Can you show us some actual numbers already?
Okay, thanks for pushing me along. What you should do right now is go find the spreadsheet for Wolf Junction, because we're going to go through the ratios for Wolf Junction the rest of the video. So if you open up the Wolf Junction spreadsheet, you'll see a tab called Ratios. And at the top, we have the ratios for the DuPont analysis. And what I encourage you to do on your own after the video is look at the different formulas so you can see how it pulls in data from the original financial statements in the first tab. So anyway, we start with return on equity, and we can see there's an upward trend, a very steep upward trend in return on equity. So this 40% means that for every dollar of investment that Wolf has gotten from their shareholders, they're returning about 40 cents of net income. I'll also give you the average over the 4 years, which we'll use later on. So what explains this upward trend in return on equity? Well, we can look at the two drivers, return on assets and financial leverage. Now, I've thrown in a third factor, a correction factor, because remember, for return on assets, we now use de-levered net income. So once you put in de-levered net income, ROE is no longer equal to ROA times leverage. You also have to add a correction factor, which is the ratio of net income to de-levered net income. This is not important. We're not going to do anything with this. I just put it in for completeness. Instead, we're going to focus on return on assets, strong upward trend in operating performance. So if you look at this 24%, for every dollar of assets, Wolf now generates about 24 cents in profit in terms of de-levered net income. If you look at financial leverage, it's been fairly steady. So this 1.68 means that for every dollar of investment from shareholders, Wolf buys about $1.68 of assets, so they're getting about 0.68 of debt. So we can say that what's been driving their upward trend in return on equity is an upward trend in their operating performance. So now we can look at the two drivers of operating performance, return on sales or profitability, and asset turnover efficiency. So we see again a nice upward trend in return on sales. This 9.2% means that for every dollar of sales, Wolf earns about 9 cents of profit. When we look at asset turnover, it's sort of been up and down. There's no clear trend. What this 2.62 represents is for every dollar of assets, Wolf generates about $2.60 of sales. But there hasn't been a real trend in this, so we can say that the whole reason for Wolf's improvement in return on equity has been driven by their operating performance, return on assets, and their improvement in operating performance is almost exclusively driven by their profitability or return on sales.
Maybe every company had a good year. Shouldn't we compare them to other companies?
Makes sense. But what other companies should we use?
Excellent point. So the ratios have shown us that Wolf Junction's had a great improvement in performance. But what we don't know is whether Wolf Junction management has done something special to trigger that performance, or whether the whole industry is performing better, and maybe Wolf is not even doing as well as the rest of the industry over this period. So we need to find some competitors to compare Wolf Junction to. So let's spend about a minute or so to talk about some ways that you can find good competitors so that you can compare other companies to the company you're interested in. So let's briefly talk about different ways you could find comparison firms. So every company has some kind of standard classification code for what industry they're in. One method are called SIC codes. Another method is called NAICS code. And you can click on these links and find out what the codes are. And then once you find a code for a company, you can find other companies with the same code. Another approach is to look at who security analysts and data services use as comparisons. So if you pick up a security analyst report, they'll often mention the company's competitors. If you go to Google Finance or some of these other sites, they'll give you a list of related companies. And then Reuters gives you industry and sector averages, which you could use as comparisons. In the end, you want to use your judgment on whether companies are good competitors or not, based on taking a look at their business and their segments to make sure they're similar to the company that you're looking at. So let's do a comparison for Wolf Junction. In the spreadsheet, I have one of their competitors, Oola Lab, and I also have the average for the specialty pet retail group. So for Wolf Junction, we can see that their average ROE is higher than Oola Lab and higher than the specialty pet retail group. And remember, for Wolf Junction, we saw upward trends in ROE, also for ROA and return on sales. But if we look at the competitor, Oola Lab, there's not an upward trend. In fact, it's going down the last 3 years. Similar thing for the specialty pet retail group. We can look at return on assets or operating performance. Wolf is doing better than Oola Lab and the industry group as a whole. Despite the fact they have lower leverage, their higher return on assets gives them higher ROE. Then we can look at their return on asset drivers, return on sales, and asset turnover. We find is that Wolf has about the same return on sales as Oola Lab. So how do they have more return on assets? Well, they have higher asset turnover at the same level of profitability. So Wolf is able to generate more sales for their assets than Oola Lab. Both companies do better than the index as a whole. And again, you don't see the same upward trends in profitability that you saw for Wolf. So it looks like the secret to Wolf's success is upward trend in profitability that's not mirrored by the industry, and they've been able to do that at a higher level of turnover than their competitors. That wraps up our DuPont analysis of Wolf Junction. What we've seen is that their large and growing advantage in return on equity over Oola Lab and the industry has been driven by their steady increases in profitability and their consistently higher level of asset turnover. In the next video, we're going to dive deeper into each of those ratios and see if we can tie back to their strategy to see what specifically they're doing that's giving them such a big advantage over their competition. I'll see you next time.
See you next video.